Hi, what I'd like to do now is talk about foreign currency translation, and this is the process by which we convert a set of financial statements from one currency into another currency to facilitate consolidation. This is done in accordance with IAS 21, AASB 121. To demonstrate this, I'm going to have a simple example of Merino Australia Limited, which acquires all the shares of the United States company Weavers on 1 July 2019. I've made this acquisition date the same as the beginning of the financial period to make the process a bit simpler. After 1 year, we have an income statement and a balance sheet of Weavers, and these are on the following slide. And throughout the year, the relevant exchange rates were, on 1 July, when the firm was acquired, 65 cents. The average for the year, 70 cents. The ending inventory was acquired when the exchange rate was 75 cents, and the financial year end or closing rate is 80 cents. What we have here is the financial statements, the income statement and the balance sheet of Weaver. And please note that when we do a translation, we're not doing anything to any account or any ledger account. It's purely a consolidation process. So what you can probably see here is that translation is probably best done in a spreadsheet, and you can see that we have the US dollar income statement for Weaver, and we apply to the US dollar amounts the relevant exchange rates. Where the transactions occur evenly throughout the year, we've used an average rate of 70 cents. So sales, purchases, admin expenses, income tax expense, you can see we've converted all of those at 70 cents. The opening inventory was purchased when the exchange rate was 65 cents because the business was acquired at the beginning of the year. And the closing inventory was purchased when the exchange rate was 75 cents. So we've used those exchange rates to convert the opening and closing inventories. We apply that throughout the income statement, and we end up with the converted Aussie dollar amounts, and we end up with a net profit after tax of $64,000 and a retained profit of $126,000. In the balance sheet, we also do this on a spreadsheet, and what you can see here is that all the assets and liabilities are converted at the closing exchange rate, 80 cents, and the retained profits is brought across from the income statement. And to make it balanced, we have a foreign currency translation loss, which would go through other comprehensive income of $58,000. How's that foreign currency translation loss been calculated? Well, we can see here how it's been calculated. It's not just a balancing item. You can see that there are two potential sources of exchange differences on translation. The first relates to the result of converting the opening net assets at the opening rate at the beginning of the year and at the closing rate at the end of the year. And you can see the result there was to realize a loss of $69,000. The second cause of differences is attributable to the change in net operating assets comparing this at the rate at which it was converted as opposed to the closing rate. In this example, we've simplified things by not having any dividend, and there's been no capital contributions. So the cause of the change in the net assets is purely profit for the period. And you can see that in the income statement we have a profit figure of $64,000, and that's effectively been the US dollar amounts converted at an average exchange rate. In the balance sheet, the change in net operating assets is converted at the closing rate of 80 cents, so that gives $75,000, and that suggests that we have a gain of $11,000 to be recognised. The net effect is a net loss of $58,000, and that corresponds to the foreign currency translation reserve amount which appears in the balance sheet.